Today, we will talk about the loan-to-deposit ratio, LDR. The loan-to-deposit ratio is used to assess a bank's liquidity by comparing a bank's total loans to its total deposits for the same period. The LDR is expressed as a percentage. If the ratio is too high, it means that the bank may not have enough liquidity to cover any unforeseen fund requirements. Conversely, if the ratio is too low, the bank may not be earning as much as it could be. To calculate the loan-to-deposit ratio, divide a bank's total amount of loans by the total amount of deposits for the same period. You can find the figures on a bank's balance sheet. Loans are listed as assets while deposits are listed as liabilities. A loan-to-deposit ratio shows a bank's ability to cover loan losses and withdrawals by its customers. Investors monitor the LDR of banks to make sure there's adequate liquidity to cover loans in the event of an economic downturn resulting in loan defaults. Additionally, the LDR helps to show how well a bank is attracting and retaining customers. Typically, the ideal loan-to-deposit ratio is 80% to 90%. A loan-to-deposit ratio of 100% means a bank loaned $1 to customers for every dollar received in deposits it received. It also means a bank will not have significant reserves available for expected or unexpected contingencies. If a bank has $500 million in deposits and $400 million in loans, the bank's LDR ratio would be calculated by dividing the total loans by its total deposits. The loan-to-value ratio is an assessment of lending risk that financial institutions and other lenders examine before approving a mortgage. Typically, assessments with high LTV ratios are higher risk and, therefore, if the mortgage is approved, the loan costs the borrower more. The LDR helps investors assess the health of a bank's balance sheet, but there are limitations to the ratio. The LDR does not measure the quality of the loans that a bank has issued. Additionally, the LDR also does not reflect the number of loans that are in default or might be delinquent in their payments. Yes, the loan-to-deposit ratio is a type of liquidity ratio. It assesses a bank's total loans in relation to its total deposits. The ratio indicates the ability of the bank to meet its obligations, payments to depositors. A liquid bank would not have issues in meeting its obligations. A high loan-to-deposit ratio indicates that a bank has made a large amount of loans when compared to its deposits. The benefit, however, is that the more loans made, the more interest the bank earns, which increases revenues. Market practices would indicate that a loan-to-deposit ratio that is above 80% is risky. This signals that a bank has low liquidity and could have difficulty paying its depositors their funds. The loan-to-deposit ratio helps assess a bank's liquidity by comparing its total loans to its total deposits. Too high of an LDR indicates a bank may have difficulty meeting its obligations, while too low of an LDR would indicate a bank is not using its deposits efficiently. Here are 3 key takeaways. 1. The loan-to-deposit ratio is used to assess a bank's liquidity by comparing a bank's total loans to its total deposits for the same period. 2. To calculate the loan-to-deposit ratio, divide a bank's total amount of loans by the total amount of deposits for the same period. 3. Typically, the ideal loan-to-deposit ratio is 80% to 90%. A loan-to-deposit ratio of 100% means a bank loaned $1 to customers for every dollar received in deposits it received. Hope this would help. Thanks for watching.